Welcome, this is Howard Sorkin at DePaul University in the Capstone 116 online class on the case study program for the CFP program. This is Chapter 9 on property and liability insurance, coverage, and auto insurance. We're going to go through some highlights. I'm not expecting anybody to become an expert in homeowners insurance or any of the other items, but you do need to understand it to help your clients as well as it's information that's tested. Without adequate liability, most people are subject to all kinds of lawsuits and might have a partner for life if someone gets injured because of their automobile or falls on their property, especially since they don't understand how this coverage works. And it says that as a risk management tool, property and liability insurance is to help protect the client's assets and to help protect the client in the event of a lawsuit. But also, it says that it's also going to help to restore the property. And in many cases, the biggest assets people have would be their home, their condo, and their automobiles. So unless you have a property, you're a licensed P&C agent, all you're doing is giving information, and you want to work with those agents, and you want to understand how losses are taken care of. There usually is a claim example on the comprehensive exam and how you have to fill it out. And you have to remember the different ways to manage risk. We've talked about this before. You can avoid risk, you can retain risk, you can reduce risk, you can insure risk, and be aware, again, how to do this. You can analyze a situation. You can decide what kind of coverage you want to help the client do, and this is an inventory slide that you might want to use as part of your financial planning program. And this would also assess liability. Most people don't realize and assume that if they have insurance, if the lawsuit is greater than the amount, it doesn't matter because they're covered. You better be careful and make sure your clients understand the insurance policy is a contract between the insurance company and the client. And if the claim exceeds what's in that contract, the insurance company is not going to pay 1 penny more than they're supposed to. Nearly all homeowners policies say that the client's going to pay some kind of a deductible before the insurance company starts reimbursing. And it's not uncommon for the deductible to be 1% of the claim or $1,000. And the higher your deductible, the lower the premium. So be aware of that. In terms of risk management, obviously, if you have a burglar alarm or a fire alarm, that's going to help monitor your costs and keep your premiums down. Be aware that you have to analyze the different kind of policies and you have to understand what they are. And typically there's going to be a couple questions on the comprehensive exam on homeowners insurance. Risk factors. Well, it says here, this might seem a little strange, but if you live in a wood frame house or a log cabin in the middle of the forest, your house is going to cost more to insure than if you're in a cement home in the same area. It's just how to figure it out. And if you live in an area where there's, in a major city where you're half a mile from a fire station, you're probably going to have a lower premium than if you live 5 miles from a fire station. What is the impact of any of these losses on your client's net worth? And it's asking here about what's going to influence the underwriting. Well, the underwriting is how the policy comes into being. The impact on the loss is how it's going to affect their life, their pocket, their finances, and so forth. So the insurance companies have figured out ways to standardize certain things. And your job and the job of the property casualty agent is to help determine how much insurance is needed to cover the loss and be properly insured. And some of this is done by formula. Some may be required by a mortgage company or a lending company if it's a car. Some of it might be what the insured wants. I happen to believe that for your condo or your home, you want as much insurance as you can get, and you have to understand the different kinds of policies. Homeowners insurance. It says what kind of construction, what kind of benefits, what kind of package you're going to get. And if you remember from the first class, the first program on the introductory course on insurance, we went through the different standards, HO2, HO3, HO5, so people understood the difference between the basic, the broad form, and the all risk. And I'm a big believer in using the HO3, preferably the HO5 plan, which is all risk open peril coverage. And it's very important that as part of your client's annual financial profile that you do review. And if you're not qualified, get the property casualty person. You don't want the liability. Under liability coverage, there's medical payments built into homeowners and auto coverage. And it will cover the insured, people that live in the home, as well as people visiting the home. Auto insurance. And again, this, whoops, sorry, I skipped a thing. Auto insurance. Make sure you understand what the different plans mean. If it says 100, 300, 100, it means $100,000 of liability per person, $300,000 of liability for one accident, and a separate $100,000 for property damage. So be aware how you understand how it works. Make sure you understand about uninsured and underinsured motorists, and understand if you're living in a no-fault state or a modified no-fault state. That no-fault insurance is not going to be on the exam, probably because it's a national exam. But if you're living in a no-fault state, you must understand what it means. You may want to also get what's called gap insurance, which is guaranteed auto protection over and above your own car. Some states require that you have that. And if you live in one of those states, you need to know about it. Excess liability coverage. Most plans will offer 100 or 300 or maybe even 500,000 of excess liability. Of liability on the basic plan, and you can purchase more. It says here umbrella contracts are not standardized, so coverage can vary. My understanding is on the comprehensive exam, they love to ask questions on do you have umbrella liability coverage and why. So make sure you review the material. Umbrella liability policies say if you've used up all the benefits that you have under your auto liability or your homeowner's liability, the umbrella will now kick in and provide an additional $1 million of coverage. The policies aren't that expensive, but it's important you look at them. Make sure you tell your clients to document things. Know what their policies have, know what the policies don't cover, what are the exclusions, and if they have to, make a notebook of all of their artwork and all of their fine jewelry and receipts, and keep it off-site for what's at their home, and take pictures of their new furniture and everything else when they move in, because you want to have some record. When you're looking at property and liability, is the current level sufficient? If it's not, change it. Make sure that you have current and up-to-date appraisals for your jewelry and your furs and your fine arts, so if there's a loss, it's properly covered. Understand that most policies have an 80% rule. Most homeowners will have an 80% rule to determine if it's properly covered, which means you have to have a minimum of 80% of the replacement cost fully insured in order to be fully covered. For commercial property, it's 90%. Make sure you understand how that works. And then there's going to be a claim example, usually on the exam. I'm trying to see if here it is. The claim example, the amount of insurance covered, how much do you have, divided by the amount that's required, which is 80% of replacement cost. So if your property replacement cost is $1 million, you have to have $800,000 at a minimum to have the 100% coverage. So if you need $800,000 and you only have $600,000 of coverage, you're not going to collect dollar for dollar. Make sure you understand how this formula works. It's very, very important because it's going to be tested. Here it's giving you some samples on how the formula will work. There's 3 rules that they're giving you. The 80% rule applies to partial losses, because if you're at 80% and you have a total loss, they're going to pay for the total loss. And the total reimbursement will never exceed the face amount of the policy. That's what I said. If you're underinsured, they're only going to pay up to the maximum. Review your liability coverage, make sure it's current. Review to make sure that your appraisals for jewelry, furs, and fine arts are current. Make sure you understand what an HO3 means versus an HO5. Make sure you're aware of the fact that flooding is not covered under most plans today, or any plans unless you have federal flood insurance. Let's see. Make sure you understand what additional living expenses are for and how that works. Please review in the textbook so you understand HO2, HO3, HO4 is for renters. HO5 is open peril for property and for content. HO6 is for condo owners, which means they're not going to cover the building. They're only going to cover the interior. Make sure you understand that the flood insurance program is through the federal government and does not work the same way. Earthquakes are usually exempt in almost every state and every policy. Flood damage is not covered under HO3 or HO5. This gives you an idea of what's covered, how the additional living expenses or loss of use will be covered, how much personal property is usually 50% of the dwelling coverage. Other structures would be detached garages or gazebos. So this is a good chart on slide 41 to help you out. Again, this was an overview. It's not meant to be the entire course. This is something we spent a lot of time on in the fundamentals course. Thank you for listening. Have a good afternoon or good evening, and we'll be going on to chapter 10 soon. Thanks very much. Have a